Welcome back. Now, COVID-19 has certainly made a massive impact on South Africa's economy, and it certainly will for some time to come as well. The announcements expected later today by President Cyril Ramaphosa are going to be quite interesting to note. And it's very interesting that in a time like this, economic relief is more necessary than ever. How do you do that, though, when you don't have the necessary revenue, the necessary stockpiles, nor the necessary data available to perhaps help when it comes to economic growth either? South Africa is bound to get a budget deficit that will not aid this picture one bit. This in the blue is where South Africa's budget deficit sat for 2020. That's at 6.3%. That's a slight increase of 6.8% for the 2020-2021 period. But with an expected spending of around 100 billion rand, according to Goldman Sachs, they believe that that's how much South Africa may need at bare minimum in order to deal with the COVID-19 pandemic in the country just locally. And that, of course, would include emergency services, and that would include emergency apparatus as well. That, however, could increase, as I said there, by 100 billion rand, which means that our spending would increase, which immediately pushes out our budget deficit then from 6.8 to 10%. A massive haul of 10%. If that really were to be the case, according to Goldman Sachs, it would push it out that much. And if you continue to get your trajectory going, this is the timeline how it would follow on from there, going all the way down to 11.7% in negative territory, of course, as a deficit. So it's negative movements when it comes to just how things would fare there. So things are absolutely horrible. It's bound to cost South Africa a lot. And this is not the picture that the ratings agencies would certainly like to look at and see over time. This is bound to hurt in accordance with Goldman Sachs. So what does that mean for South Africa's growth picture? Well, budget 2020, we expected growth figures from National Treasury, that is, of at least 0.9%. So some growth, better than 2018 growth and better than 2019 growth. But are we going to get that now? Well, just last week, Thursday, we saw the South African Reserve Bank say we're only going to get negative growth of 0.2%. That is a contraction, the first of its kind, of course, since the financial crisis of 2008-2009. Negative 0.2% is a conservative estimate by the South African Reserve Bank. Things could get worse. Goldman Sachs says things could go to 2.6% negative growth. That is an absolutely massive fall for an economy that calls itself an emerging market. Unfortunately, the scenario then for this 2020 growth picture isn't just about ourselves, but it is about how stockpiling isn't necessarily going to help now, when perhaps as a country we should have been stockpiling on funds a little bit earlier on. In the year 2008-2009, we still had a current account surplus, we had a trade surplus, and we had a budget surplus. At that point in time, South Africa could have considered having a fund of sorts, which we continue to tout so heavily now. But unfortunately, that time has seemingly gone. We don't have the ability to spend as much as we'd like, and it's going to impact this picture quite tremendously. The range for now sits between 0.2 in negative territory to minus 2.6. It's going to hurt South Africa, unfortunately, but right now is going to have to be a time to throw the budget out the water and just stick to what we know best so that we can come out of it in a better way. The OECD even saying then that it's going to take a very long time for any country to recover from what has happened here. Perhaps it's time to press reboot. Let's check on how things fare out in Asia then. Those stocks falling this morning amid a wider sell-off on coronavirus fears, though losses were limited as Beijing began to signal what was some further support for its markets and as, of course, new cases dropped in that country. Now, the Composite was initially more than 3% down in early morning trade, tracking what was a slump in other Asian markets as a rising tide of national lockdowns began to threaten and overwhelm policymakers who were making frantic efforts to cushion what is likely to be a deep global recession. Now, Japan's Nikkei was up, however, perhaps aided a little bit more by expectations of more asset buying by the Bank of Japan. Shanghai Composite Index losing 1.6%, unfortunately, today, sitting at 2,701 points there. The Nikkei over 2% lower as well today, so not a good day at all, while the Hang Seng 5.2% lower, ending the day 21,617 points. On Wall Street, well, last week, Friday, still not the greatest week then for the Wall Street, for the markets on Wall Street, finding the likes then of those markets going down. Dow Jones Industrial and the average, the S&P 500, sliding more than 4% as tough restrictions imposed by New York and California to try to perhaps limit the spread of coronavirus fueled worries about damage to the U.S. economy. The Dow Jones Industrial around 4.5% in negative territory, 19,173. S&P 500 4.3% down, Nasdaq Composite 3.8% down. Let's just remember that these stocks were sitting in record territory on February the 19th. That's just over a month ago. When Trump, of course, took office back in 2017, we're down 3% from those levels alone. Let's head on over now to Europe and see how things are faring there. Again, the sentiment here has been about just how much stimulus can you offer a market that certainly is in need of it all at this time. The FTSE 100 unable to take in any gains, neither was the DAX or the CAC 40. Of course, Europe has become the epicenter as well of COVID-19 now, rushing away from China and Southeast Asia in particular, and now going on to Europe, where it finds itself trying to find and hustle away, if you want to call it that, to try and fix the scenario, whether it be by boosting liquidity, aiding markets, pushing out more funding. I mean, the likes of Australia even saying that they're going to give small businesses 100,000 Australian dollars in order to try and deal with what is happening out in COVID-19. So small businesses still being a focus across the board. So how do things look then on the local front then? That has been of key question. Unfortunately, we are still down 37,872 points. We just sat at around 58,000 points earlier this year. So we've seen things really just go under for quite some time now. And it really is beginning to hurt all these stocks, really not only a few. The industrials, also financials, going into negative territory. Onto the commodities share front as well then. Those have certainly also been hammered of late. One, as I keep on harping, thought that perhaps the gold counter would have seen, and gold shares also would have perhaps seen some gains. But investors shying away from even what we considered safe havens and really just finding anywhere that they can get money. Right now, it seems like cash is king by the looks of it. Let's head on over to that commodities board as well then, and you'll see that the oil price still $25.90 a barrel. It's down around 2% today as well. So even more fears continuing to permeate. These are figures we haven't seen in quite some time for that oil price. Platinum, $6.19, keeps on diverging away from that gold price, which isn't necessarily going up by too much either. In fact, sitting in negative territory today. All right, here are your currencies then. The local currency finding itself in some uncharted waters there. 1772 still against the US dollar. 18 Rand seems to be that ceiling, but it is edging ever closer to it. 18.92 for a euro a pound. Set you back 20 Rand 53 cents. Quick look at those BRICS currencies then as well. Of course, negativity still reigning throughout on that one. Bright Khumalo from Vestac Asset Management joining us then as we get to more of this information. Bright, what more can one say? There's just going to be a state of negativity and it's going to hurt.
Yes, I mean, Aravile, thank you for having me today. We're still in the middle of that storm, as you're saying, that, there hasn't been much on the positive side of things. But, the past situation, the resolution depends on, what the lawmakers do and our politicians do, or tell us to do, for that matter, to get us out of this rut. But so far, unfortunately, we just have to hunker down and wait for that announcement from our president, Ramaphosa, tonight.
Should we be worried from an equity front, though, Bright, do you think? Because, and the reason I ask this is because you would hope that in a time like this, there wouldn't be induced panic, that investors would know that we just need to roll out and wait for, for the long game here. But it feels like the long game is too far away.
Yeah, sometimes it does feel periodically like that, and this is one of those times. But I guess you have to be patient and roll with the punches take it from the chin, and just hope for the best, and don't abandon your investment philosophy. This is not the time.
Yeah. What would you give as an investment philosophy now? For example, we keep educating people, telling people, asking people, making people think about getting into equities. What do we say to them in a time like this to say, yeah, definitely get into the JSE? Why?
No, the reason why is because just like the saying, you buy your favorite item of clothing, you go to the shops, you look at what's on the catalog, and if you like it, you mark it, and you maybe take a couple of pictures, you keep it around, and when it's on sale, you actually go out in droves and you buy that as much as you can, right? Because you like it.
Yeah.
The similar approach works with investing. You go and this is the period where you see those periodic sales present themselves. And you look at those quality companies, big blue chip companies with a lot of cash in their balance sheet. For example, you look at a company like Alphabet, the holding company for Google.
Yeah.
It's sitting on 120 billion, US dollars in cash, and they have zero debt. And you've got Apple with 110 billion US dollars. You've got many other companies who fit, that same category, of having a lot of, cash in their balance sheet, and with no debt, and which they will use that cash in this environment to take advantage of opportunities that present themselves.
Yeah.
So that's where you want to be invested at these cheaper prices. I mean, I don't understand why a company like Amazon, for example, which has shown certain demand for its products because of the environment that we are in. But if you look at the share price, the company is down over 35% since their highs in the 19th of February this year. So these are the times where you have to be circumspect, you have to be still, you have to think carefully and not be part of the herd or the 99% that's rushing for the door.
Yeah, it just keeps on sounding like an excuse to just leave the market for whatever reason. Let's quickly talk about the...
There's always an excuse to leave the market, but don't be one of those people right now.
Okay, let's talk about the currency very quickly. 1772 now, somewhere thereabout. 1795 was seemingly one of the worst figures we've seen. 18 Rand, is that a ceiling?
At this point, anything is possible. I mean, we saw yesterday in the United States Senate not agreeing in that 1.3 trillion US dollars of stimulus, and which has sent markets basically coming down with the US dollar strengthening, meaning again emerging market currencies are taking a big hit as a result. There's a lot of moving parts there. I mean, I mentioned America. You would have thought that the rand had to do with anything with America, but that's where we find ourselves today. 18, you ask me, I say it's very possible at this point.
Yeah, it becomes...
We're actually closer to 18 than we are to 14 where we were a couple of months ago.
Yeah, where we started the year, actually. Yeah, so very true, so very true. Bright, appreciate the time, bud. Keep safe and stay healthy, man. Chat soon. Bright Khumalo there from Vestac Asset Management, joining us via Skype then, of course, as we unpack that market movement. It gets scarier every day. The losses just keep on piling on. Hopefully tomorrow I'll get you a sense just of where exactly we are, how far we've fallen just this year alone. Let's give you more news right after this. Stay tuned.